The best way to invest money in 2022. Introduction. Investing well can help you build wealth, create a powerful income stream, and find your retirement. But to achieve those goals as planned without adding undue risk, you need the right strategy, the best investment, and time. Poor investment choices, on the other hand, lead to underwhelming results, and it matters. Essentially, investors can waste time or money when it comes to other financial goals, which likely include emergency fund, home down payments, education expenses, grow wealth, retirement saving, and income. So where to invest money? You can invest money in stocks, like individual stock shares, stock mutual fund, stock ETFs, index funds, S&P 500 index funds, dividend stock fund, Nasdaq 100 index funds, international stocks, small cap stocks, or bonds like treasury securities, government bonds, short-term corporate bonds, long-term corporate bonds, high-yield bonds, municipality bonds fund, cash equivalent investments like high-yield saving account, certificate of deposits, money market accounts, money market funds, or blended portfolios like balanced portfolios, asset allocation portfolios, target date funds, and real estate, rental housing, commercial real estate investment funds, and finally annuities, fixed annuities or variable annuities. It's a good idea to narrow the field and focus on the type of investments you are most likely to select for your portfolio. You will want to understand how each investment performs and what type of risk it involves so you can make an effective decision, especially if you are just learning how to invest. Here's a brief summary of what you may expect from each of the main investment categories listed before. Stocks represent an ownership share in a particular company. These shares are traded on public exchanges, so they can be bought or sold at any time. Stocks represent an ownership share in a particular company. These shares are traded on public exchanges, so they can be bought or sold at any time. Over time, stocks as a whole have provided returns that have easily beaten inflation. This makes them a good investment for long-term growth. However, they can also have steep losses that sometimes last for several years. Stocks can be bought individually or in a large group via a mutual fund or diversified portfolio. Owning several stocks instead of just one or two may water down your return, but it also cushions the risk of any one company failing out of favor or even going out of business. Stock prices depend on two things: how a company's business is doing, investors' opinion about the future of the company. Because business' condition and investor mood can change quickly, stock prices are subject to large, sudden moves for better or worse. When price volatility happens due to economic factors specific to a company or industry, it's known as unsystematic risk. However, systematic or market risk that affect the entire stock market at the same time is due to large economic forces like interest rate change, political turmoil, or recession. A diversified portfolio will not be able to mitigate both types of risk. Diversifying can only help hedge against unsystematic risk. Bond. A bond is a debt obligation issued by a government or corporation. Investing in one is like lending the issue money. They agree to pay you back the money at a specific time, plus interest at regular intervals. Despite these scheduled payments, bonds can go up or down in value and even have permanent losses if the issue does not make its payments. The amount of risk depends on how reliable the issue is and how far in the future the repayment that is. Bonds can provide an investor with regular income and also add some stability compared to owning just stocks. However, the level of income and amount of stability depends a great deal on the type of bonds. Bonds can be both individually or via mutual fund. Because bonds typically trade in large amounts, it can be more efficient for a typical investor to buy groups of them through mutual funds. Cash equivalent. Cash equivalent is a broad term for investment that combine total stability with easy access. They are also often referred to as liquid investment. Cash equivalents include accounts and instruments that do not go up or down in value. They typically pay interest, but because of their safety and accessibility, their interest rates are generally pretty low. The purpose of cash equivalents is to keep money ready for near-term spending. They can also be a useful place to put money while you are deciding where to invest it next. Examples of cash equivalents include saving and money market accounts. Money market funds are also commonly used as a cash equivalent, but they are different from money market bank accounts. Certificates of deposits can be used as cash equivalents in some cases, so they usually have some restriction on their access. Blended portfolios. Different types of investments such as stocks, bonds, and cash equivalents are known as asset classes. Each act in a different way, but it's unlikely that any one asset class can meet all of an investor's need all the time. That's why investors typically own a mix of different asset classes. A blended portfolio combines some of the characteristics of specific asset classes, but without the extremes. So, a blended portfolio will typically be less erratic than stocks, but with less return potential. It should do better than cash over the long run, but with less stability and access. It will be probably have a lower income yield than bonds, but with more growth potential. There are different ways to blend asset classes in an attempt to achieve the right mix of risk and return. Examples include balanced portfolios, asset allocation portfolios, and target date funds. Real estate. For most homeowners, real estate is already their biggest single investment. However, aside from the house you live in, you can also benefit from other ways of investment in real estate. Real estate investments can perform in a number of different ways. They can provide rental income. They have the potential to increase in value. They can simply be assets that respond differently than the stocks and bond markets. Real estate investments are broadly divided between residential and commercial real estate. You can own individual properties or invest in a pool of different properties via a real estate investment trust. When investing in real estate, it's best to be in it for the long haul. Also understand that the particular risk and reward characteristic of the real estate you buy depend greatly on the type of properties you purchase, where they are located, and what price you pay for them. Can investing make you rich? Investing can help you to build wealth if you are using the right strategy. For example, buy and hold investing involves buying investments and holding into them long term. The goal is to sell those investments later after they have increased in the value. Remember that the longer you stay invested, the more opportunities you have to benefit from compounded interest. So, in terms of getting rich from investing, time can be your most powerful tool. Is $100 enough to start investing? Yes, it's possible to start investing with as little as $100. Many online brokerages allow you to open an account with $100 or something less. If you have $100 to spare, you can use that to open and fund a brokerage account from there. You can make your first investment in stock, mutual fund, exchanges trader fund, or other securities. Keep in mind that $100 is a good place to start. If you want to grow wealth over time, you will need to make additional contribution to your investment account. For example, you may start investing with $100 and then invest $100 each month going forward.